you're very welcome to our Practice News webinar for December, our actual final Practice News webinar of the year. We normally do about 6 Practice News. They have remained immensely popular, and this morning we actually have over 500 people booked on, mostly members, but some non-members as well, and students and so on as well. You're all very, very welcome. Basically, it's another packed session, and Conal, if you can click ahead, I'm just going to give the attendees just a very quick overview of what we're going to talk about. Firstly, I'm going to delve into, as usual, 3 news items that are particularly pertinent for anyone in practice over the coming weeks. And the first one is one I'm sure you're very, very familiar with, particularly if you're an auditor, ISQM, and the actual looming implementation deadline now of the 15th of December. I'm not going to go into too much detail on ISQM this morning, but I am going to give you some pointers wherever you're at on your journey to implementation with relation to the guidance and help that we have here in the Institute that can help you along. The next thing then I'm going to talk about is one that is very timely, is the RBO. And I'm saying, are they sharing too much? And some of you might be familiar, hopefully a lot of you are familiar with the recent European Court of Justice ruling there from just last week with relation to saying that the actual different RBO and the different actually money laundering directives have overstepped the mark with relation to the actual level of information that they share to the public. Give you a bit more of a ruling on that and its impact on the RBO as well. There has been some updates on that this week. The next thing I'm going to talk to you about is the Members Hub. And the Members Hub has been given, we can say, a facelift in recent days. And I'm sure you're familiar with the Members Hub, and the whole idea of the Members Hub is to gather together in one place all of the key materials for you as a member, be you in practice or you're in industry, so that you can gain the most from your membership. So I'm going to talk you through just what is materials are there. It might be helpful to you if the next time you're trying to find it from a technical document, learn about a district society or different things as well, and just run you through that, and in your own time you can be browsing through again and getting more familiar with it. Delighted as yes to be joined by live here this morning by again by Gerard O'Sullivan. And Gerard is going to give us like the update with relation to a busy Irish autumn, the finance bill after the budget, and also just his own interactions and his team with revenue and so on. And again, I'm also delighted that Leon Shadoran, our UK tax lead, has made a very detailed recording, about 20 minutes long, and we'll be putting that out at about 11:10. As we all know, it's been one hell of a period of change in the last 3 months or so in UK government circles, and with mini budgets, and then with the autumn statement and so on, and also making tax digital still there. And Leon shall be going into some detail, and also the advocacy that she and her team do with HMRC and so on behalf of our members. And our main guest speaker today will be Elaine McGrath, and Conal and myself will be having a chat with Elaine about a very popular topic of buying and selling your practice and the legal perspective to think about it. Also incorporating your practice, which is becoming increasingly popular, and we often get questions from members on this. So hopefully you'll find that session very informative. I'm sure you will. Conal, if you can click ahead, just to give you a quick overview of who we all are today. Again, I'm sure the vast majority of you are familiar with myself and with Conal. If you're not, formally introduce myself. My name is Jeremy Toomey. I'm a practice consulting manager here with Charlton Accountants Ireland. Joined the Institute about 5 years ago now in August 17. I'm delighted to be joined here by my co-host, Conal Kennedy, who is the head of practice consulting. We have our regular tax speakers here today. As I mentioned, Gerard O'Sullivan will be giving the Irish tax update. Gerard, I think it's his third practice news, joined the Institute about a year ago now, and is based in Cork this morning, so we're getting around the island and so on, and is a tax consultant. And Leontia, who has been a little bit longer with the Institute, our UK tax lead, and also dealing with student who has a very detailed recording. And Leontia will be based in our Belfast office, and I think lives around Dungannon and so on as well. So basically, delighted to have our special guest, Elaine McGrath. And Elaine is a partner at the leading Dublin law firm, Reddy, Charlton. Now, as well as being qualified solicitor, Elaine would specialise in corporate and partnership law. And she has a good deal of experience over the years in advising professional service firms, both on the aspects of incorporating, but also with relation to the legal considerations to think about in succession planning, in potentially buying other practices, and actually potentially selling practices. So right across from the the legal area, other professional services like accountancy, even veterinary practices and so on as well. So I'm sure that Elaine will give some great insights, some key considerations to think about if you happen to be in that space, a buyer or seller, or incorporating your practice. Cool. That is that. So that's everyone on our side of the fence. For you guys, the attendees this morning, as I mentioned, we have well over 500 people actually booked on this webinar, and I think we have well over 260, as you can see. They're live at the moment, but that'll add up again more. Again, we have people right across the island and beyond. I think we have some people even joining us here from Malta, Australia, and different ends this morning, and a lot of people, as I say, do catch the recording as well afterwards, and it's great to be able to delve into that. No surprise, it's mostly members in practice, senior FCAs. And again, we have some people from business. You're very, very welcome. That's the breakdown of where location you're coming from. And yeah, you can see, I think there's a dot there in every county in the island. So that's great to see. Well, if you click ahead again, yeah, just our disclaimer, and that's particularly important here for this webinar, where we attempt to give you just a taster of what some of the key areas are, like ISQM and so on, but it is only for 5 minutes, and we're giving you links off to other guidance materials where you can have hours of review and work. That's particularly important here, and we try to summarize in as much detail as we can. Again, if you have any particular circumstances on, we'll say, talk about incorporating your practice or actually buying and selling a practice, of course, that's an area where you will need to get specific legal advice. We do have guidance and documents available as well, and you can consult with us. So do be aware that don't rely on everything you actually hear this morning as applying exactly to your circumstances and your practice, because of course they will be unique. So that's the introduction, Cornel, and good enough there to pass me on to the practice updates. And as I mentioned, I have 3 practice updates to give you this morning. I'm going to kick off with audit and ISQM. And Cornel, if you can click ahead again. Look, this is one I'm sure that you're well familiar, be you an auditor or not an auditor, with relation to ISQM coming down the tracks. We have been trying to herald it, I suppose, for the last year or so here in the Institute, and to give you enough time to actually prepare. The actual deadline now is looming, less than 2 weeks away. And so this morning, I just want to give you a quick update wherever you are with relation to ISQM, if you are preparing towards it as an auditor, of what assistance and guidance is there for you. Now, firstly, if you haven't heard of ISQM, what is it exactly all about? And it is a new quality management standard and a new system of quality management that needs to be put in place. So designed, implemented, and begin to operate by all audit and assurance service providers, all practices in that area. And this is internationally. I came out from the IASB. It's in the UK and in Ireland, so FRC and IASA as well. And the actual first bit, doing your risk assessment, getting your system in place, and then moving it forward. The implementation deadline is just under 2 weeks on the 15th of December. Now, wherever you're at, as I say, you might even be just starting out on this. Look, the good news is there is help at hand here. And first thing, I just want to outline to you what has Practice Consulting in the Institute been doing to help you along in this. And I'm sure many of you are aware, we actually have put out our resource pack, a toolkit in other words, which giving out a template set of policies and procedures of how to actually prepare your actual risk assessment and prepare your system of quality management actually to meet these requirements. So it's a mixture of a Word document setting out the objectives, but the key document here is an Excel spreadsheet where we give the actual the risks and allow you to put through what risks your firm will face. We give you example risks that might be very helpful, be you a sole practitioner or be you actually a larger firm and a larger auditor. And then we also give you example deficiencies, and we give you example actual remedies for these. And that essentially, when you put it all together, and you need to tailor it for your own practice, of course, you can't just take all of the examples and go, that's applicable to me. But it is very, very helpful, and it's been selling quite well. If you want to learn more, you can click the link there to the resource pack. It's available half price to PQA users as well. Now, we have hosted 2 webinars in this area since early October. The last one was last week, both half-day webinars, very well attended again. I've had some feedback, and I think people found them quite useful, and we do actually go into some level of detail of how to use the resource pack in that as well. So if you're just starting out and you're looking for some inspiration, the resource pack #1, but also get a copy of the recording there, which you can click through that link there, and you'll be able to purchase and download it there. Now, basically, again, finally, if you're looking for some other guidance or maybe some high-level guidance for people who are not in the audit area but still need to be familiar in your practice, the Institute has some web pages, free web pages there. There's free IASB guidance, both on how to implement the actual new quality standard in your practice. And IASA has put together about 4 or 5 videos in total. They're about half an hour when you can combine together the 4 or 5 videos. They break and go into detail on the 3 key documents of ISQM, ISQM1, ISQM2, and ISA 220. So if you're looking for high-level guidance there, maybe just starting out on your journey learning about it, there would be a good point to start as well. So look, guys, hopefully you'll find all that guidance very, very useful. I think the main thing I can say here in summary, if you are just starting out or you're very early on your road to getting this work done over the next couple of weeks after all the personal tax deadlines and things, is that the main piece of work you have to do is, of course, your risk assessment for your firm. There is a little bit of work here in this, maybe a day or so's work for every firm. Having a toolkit or having a resource pack, be it from ourselves or somebody else, will be a great help to you to give you some examples, but you will have to tailor for your own requirements. And the main thing to say to anybody is to start working on this. You're not expected to have perfection by the 15th of December, because this system of quality management will constantly be updated afterwards into 2023 and beyond. But basically, start working on it now, get familiar with it, and then you can evolve and improve it into 2023. Conal, you may have some thoughts there on that as well, as I say to you, with relation to ISQM.
Yeah, look, I mean, this is... obviously, it's a compliance burden on people to have to do it, in a sense that it is a piece of work, but there's a lot of benefit to be got from it, in that, you know, you are looking at your practice from the top down and saying, you know, how is it possible that we could get things wrong, and what are we doing about it? Looking at your practice as a whole, rather than doing that at a micro level and job by job by job, you're stepping back and taking the helicopter view. And you know, if you have had difficulties with audit compliance before, if you've had poor results of visits and of monitoring visits and so forth, there is something you need to be doing. I mean, obviously, if you're in the top of the top and you're getting A ratings recently and stuff like this, you know, you're probably not doing too much wrong. But if you're not, if it has been a difficulty for you, or if you have, or if you can see difficulties, or if you've got difficult clients, or highly regulated clients, or clients with a lot of issues, you know, you've got things to think about. And you should be putting in place a coherent plan for how you're doing your audits, and all before 2 weeks' time. So it's the deadline is on to at least have made a good attempt at this thing by 2 weeks' time. Back to yourself, Jeremy.
Conal, I'm going to click very quickly through the next couple of news items now, and the first one is the RBO. And I'm sure most of you here, but maybe if you're based in Northern Ireland, UK, you might be familiar. The RBO is our Register of Beneficial Ownership, and it has come into play courtesy of EU anti-money laundering directives. Now, I'm sure many of you have heard about this recently, and particularly its impact on the RBO, where just last week on the 22nd of November, the European Court of Justice made a ruling with relation to a case that was brought in front of it by some entities, I think companies based in Luxembourg, on the level of information that actual equivalent of the RBO in Luxembourg was allowing to be accessed by members of the public. And in the actual ruling, it said that the provisions of the 4th and consequently updated by the 5th Anti-Money Laundering Directive that require information on the beneficial ownership of corporate and other legal entities incorporated in member states right across the EU to be accessible in all cases to members of the general public was invalid. If you want to learn more about the ruling, nice, very good, detailed 2-page update at the first link there from the ECJ. Now, of course, this ECJ ruling basically is saying that the anti-money laundering directives have overstepped their remit, that basically to achieve their objective of trying to decrease the chances of anti-money laundering and entities being set up for this purpose and hidden ownership and so on, that it's basically releasing too much information into the public domain, and that needs to be pared back. Now, this actual ruling by the ECJ is a binding ruling right across the European Union on each country. And of course, each country has its own register of beneficial ownership. So the ruling was with relation to the Luxembourg authority, but the Irish RBO has had to look at this as well and decide what its course of action would be. And just this week, as a result of the ruling, it has suspended its actual company's register search facility for beneficial ownership. It had two levels of access to this. The first level would be where all the information, including PPS numbers, addresses of people and all that was put in for beneficial owners or companies, would be accessible to An Garda Síochána and to other authorities. And the second level was a more restricted level, which was what accountants would be using to access just enough key information for the actual anti-money laundering checks, and the checks you would normally do and you're compelled to actually do with relation to before taking on a client, that there's no discrepancies on what you know to be the beneficial ownership of the entity or company versus what is actually on the register and put in by the company originally. So that actual feature now, search facility, has been suspended in recent days. The actual, of course, it's preventing you as a designated person now doing these checks. And the RBO, in our interactions with them this week, have informed us that basically, look, they're working very quickly on an IT solution to address these needs. Now, how quickly this is going to be, I'm not quite sure. We would hope that it would be in a matter of just a number of weeks to get this actual function up and going again. We will keep you further updated. It's a story that is very new and very evolving and has, I suppose, far-flung implications as well for the RBO. But what they do intend is to put a feature in place to help designated persons, such as professionals like accountants and solicitors, to meet this requirement. So we'll actually keep you posted in the meantime. I think we might have a question on this. Is there, if the client works, okay, again, we'll look at some of these, Conal. I may leave you look at some of those questions and we can take them later on, as I say to you, because we're getting into very much detail on this, but we just want to update you on that one first. So Conal, if you can click ahead.
Okay, I will do indeed, yeah. I don't think that has implications for the UK, to be honest.
Yeah, no, I don't think it has implications for the UK. The UK is not part of the European Union, as we know anymore. And we'll take a look at some of those other questions, which I think are more getting into the nitty-gritty of working of the actual register itself, which is what we haven't time for here this morning to be getting into.
Yeah, we might take that in a subsequent auditing lecture, you know.
Yeah,
I think that's what we'll do. Yeah.
Indeed. Well, listen, that is the RBO. Just to give you an update, keep an eye out on e-news and on other bulletins with relation to the actual updates that we'll be getting from the actual RBO and from dealing with the CRO as well on this matter. And we'll keep you informed of when they will get back to actually having that search facility up and going again for designated persons. Again, Conal, the next area to look at is with relation to the Members Hub, and the actual Members Hub, as I mentioned, has got an update, and the whole idea of this update here is to bring together all the key information for members, be they in practice or actually in business, to allow you to knock more use actually out of your membership, and to have all the available guidance that has been a lot of time and effort to put together to make it easier for you to find. So Conal, if you can click ahead again, there's actually in this new members area, there's all the key work and key resources available to you have been put together in these 8, I suppose, essential boxes. First one here, just top and the top on the top left-hand corner here, groups and societies here. They're telling you about all our different network groups, district societies and different groups. And I'm sure if you go through that, some of them have been there a long time, some of them are very new, like diversity and so on. And I'm sure you might find one that you're not familiar with, or maybe you're interested in joining yourself. Of course, we have features like support and wellbeing, and that would be our old, what wasn't it called before, the old CA support, now Thrive. In the past, we've had our lead, D. France, on talking about different benefits there. There are a lot of webinars and even free actual sessions and coaching sessions and so on that can put in place if you need assistance there. And of course, CA support does help out many accountants who are struggling financially and so on as well, and in tough situations. We have our coaching and recruitment service with Karen Lanigan and also with Dave Reardon. There is actually one tonight I had forgotten about myself. There is a career coaching session actually outlined on that's available to everyone as a member of the Institute, freely available. So you might have forgotten about that. Other details look it goes into is professional developments, our professional diplomas, also our webinars and upcoming webinars, the Knowledge Centre, a key area for anybody here. We have our technical hub, we have our tax and ethics, we have Accountancy Ireland, Brexit, all the different knowledge centres. And also then people often ask me, where can they get the logo, the brand, something to promote their actual firm, use it on LinkedIn. That box there, just on the, I'm going to say the bottom right quadrant with the red blazer there, that is actually where you'll get all that information there if you click through to the link at the top of the page. And communications then as well, e-news and all the past editions of the different bulletins. Guys, there's a lot of information there for you and a lot of things that I'm sure you will be familiar with, but some things that you won't be. So it's a great opportunity if you do have a chance in the coming weeks or into January to flick through and actually see what is there for you. And I'm sure you'll pick up some useful tips and information that you can bookmark and have going forward. There's also some very useful videos where members actually outline what experiences they've had in working or dealing with the Institute or being part of committees and how how it's helped them in their professional lives. And one actually we have here for the groups and societies is by our very own new Members in Practice Committee Chair, Maeve Hunt. Maeve is based in Belfast, a director with Grant Thornton, and Maeve just joined our Members in Practice Committee in recent weeks. She's also a council member, and Maeve will actually be joining us in one of our upcoming Practice News webinars in early 2023, just to talk through a little bit more about the work of the Members of Practice Committee and if you'd like to be involved and so on as well. So look, guys, if you want to learn more, as I say, about the Members Hub, best thing is to do is to click on it and actually take a look around yourself, and I guarantee you, you'll find some good information there that'll be useful to you. Donal, I think that is pretty much me done there on the news item.
Sure.
Is there any new questions?
Jeremy,
on that?
You've been talking at 19 to the dozen there. You're getting loads in. One firm there can still access the RBO. So I'm not sure whether that's because they haven't closed it down yet or because they've moved really quickly to open it up. If you haven't been using a designated login as a designated person, I expect that it's because they haven't properly closed it down yet. I expect that is the issue there. So that is that. Listen, can I just say one thing before we just go any further? We've got a huge number of bookings on. We'd like to thank members for their support of Practice News. We've got over 500 bookings. I can see it's almost 300 on at the moment. When I look at the people who watched the recordings, it was almost 400 people watched the recordings of our last one. So this is really reaching out to members, and we really appreciate your support in coming to this, and we'll certainly keep doing this. This started out in the pandemic, but I think it's reaching members because you keep coming back, and I'd like to thank you for doing that, and to say that we're definitely going to keep doing it. Now, onwards to
we're moving from Dublin to Cork, and I think Garrod, hopefully you can hear and see us, and that you'll be joining us. Oh, I love the background and all. Actually, that's a background you can get on the communications link I talked to you there on the Members Hub. So it's a great way of promoting your firm and so on as well. Well, listen, Garrod, you're looking like the ideal tax accountant there. I know it's been a very busy week even for you. You were on the Republic of Ireland Tax Conference yesterday, meeting at Talc and so on as well, I understand. And I know you've been with us a couple of times here. And of course, the finance bill has been working its way through the Oireachtas as well. Before I say any more, I think I'm just going to hand over to you, and the floor is yours for the next 20 minutes or so.
Thanks very much, Jeremy. And yeah, it's been certainly a busy couple of months now at this stage for the tax department, certainly since our last update. And as you can see from the slide, that hopefully you can all see it now. Today, I'm going to just update you on some of the key measures for Finance Bill 2022 and have a quick discussion around some of the recent meetings of the Tax Advisor Liaison Committee. So one thing I'd like to do just off the bat is actually I'm going to share a link first here into the chat that hopefully you all get. And this, sorry, oh, it's the wrong link there. Let me just double check that. So this is our Finance Bill at a glance document, and if you haven't seen it already, I'd highly recommend having a look at it. It links back to our newsletters that we released at budget time, and there's quite a lot of information there as well in terms of the specific changes, and it really gets into the details. So it's a handy resource for all accountants and advisors. So just we'll start looking at the temporary business energy support scheme, because I'm guessing I know it's certainly the one that's been the subject of a lot of discussion at Talc, and certainly we're getting queries about it. So the detail of it, as I say, is included in the finance bill document there, and I don't want to rehash that. You know, I suppose the main thing is that it's available to trade case 1 or case 2 trades or professions, and I'm getting some queries around, say, case 5 management companies and this, that, and the other. The legislation seems fairly tight. It's case 1. Case 2, and in fact, when this was released initially at budget, it was only case 1 trades who were included within the temporary business energy support scheme, and I'm going to start calling it TBES now for the rest of my time talking about it, just so for obvious reasons. It's quite a mouthful. But yeah, we lobbied ourselves, various other representative bodies, as we couldn't understand why a case to profession, particularly if you think of a trade like a dentist, where there's significant energy costs associated, doctors, vets, etc. Why these were overlooked, and I think it was just a technical error more than anything else. But anyway, case one and case two. Trades and professions may make a claim, and you have to have a year-on-year increase of 50% on your gas or energy bill, and you get 40% of the difference back, and it will be administered by revenue. To keep in mind here, so what's needed from us as accountants? So first thing is tax clearance. So you'll have to apply for tax clearance for clients that want to make a claim. Revenue, the portal should be up and running now. Hopefully some on the call today have started this process, but if you haven't started the process, this is the first action point, is to start tax clearance, particularly for clients who have not applied for tax clearance before, or yourselves if you haven't, but probably less concerning for accountants ourselves, but certainly for clients. Start that tax clearance process. There is a specific button now on the tax clearance portal for TBES. So secondly, start compiling the records for the reference period and for the claim period. So the reference period will be the period in 21 up to 22 in which you'll be making the claim. And the claim period obviously is the same period, the same month or period in 22 or 23. The scheme is running from September 22 to February 23. Payments are going to be made at the earliest by the third week in December. So I think that's another important point to keep in mind from a cash flow perspective. I presume now, if you've already had some preliminary discussions or whatever level your discussions with your clients are at, the payments will be pending final approval from the temporary crisis framework. That's the EU temporary crisis framework. That's expected, but payments cannot be made until that approval has been received. And as I said, it'll be third week in December, we've been told, at the earliest. So if you get a claim in by the end of the first week in December, so we're just into December. So basically, you want to get the claim in, I'd imagine by Wednesday, Thursday. I'm not sure, Friday. It depends with revenue, right? But as we said, if you can get the claim in soon, hopefully third week of December, but that will be the earliest that you'll be able to make a claim. Some other key points to keep in mind with TBES, it's the VAT exclusive amount. Now that's in the guidance, so you'll find that there. It's the VAT exclusive amount that you include in your claim. So that's important, because obviously if you have a significant energy bill, if you're including the VAT inclusive amount, it's incorrect. You'll be claiming too high a payment, and obviously there's implications there, because it's incorrect, and you'll have overclaimed, and all the risks, etc., that are associated with that. It only applies for businesses with a GPRN and or an MPRN. So you can claim for gas and electric or the combined costs, etc., but you have to have an MPRN or a GPRN. If you have some sort of service agreement with your landlord, whereby they pay the electricity costs and there's some sort of recharge of this, because you won't have your own MPRN or GPRN, you won't be able to make a claim. And so that leads on to the likes of LPG and other sources of energy, whereby there isn't a reference to an MPRN or a GPRN. It's a policy decision. This is how they can operate the scheme, and it's important, obviously, to bear that in mind. So some of the key, so say quite a bit there with the TBES, but there's obviously quite a bit of detail in the guidance as well. And the guidance notes have been updated significantly recently. Now they include screenshots of the actual process of working through the TBES portal. The TBES portal should carry out the detailed calculations for you. So as accountants here, we're not actually being required to do detailed calculations. So you shouldn't need to have a detailed understanding of tax legislation to do this. It's just a matter of getting onto the portal, but it is about getting the right information and inputting the right information. So it's a gather and input exercise, but again, we have to be precise here, VAT exclusive amount, and it has to be, you have to have that GPRN, MPRN, and tax clearance. Final piece just to mention on the TBES is this carbon neutral journey that you need to complete. So we've released some information on tax news, and we'll release that again next Monday, just because it's come up as a query. But there, the Department of Finance have a portal. I think it's the Department of Finance well, actually more likely the Department of Energy, but the other departments. But anyway, where you can complete an exercise to start this carbon footprint journey. So that is available, and we'll include a link to that in tax news this Monday. So look, said quite a bit there about the TBES. If there's any questions, please do send them in, and we'll do our best to answer them. Hopefully, I've kind of covered off some of the main bits, because I've gotten quite a number of queries at various things over the last few weeks. So hopefully, kind of answered some of them. Just some of the extra measures now that you will have seen in finance bill that I want to mention. So you may have heard of this returns by employers and reportable benefits, the new section here, which will require reporting of certain benefits. So the daily working allowance, I think, is included. The subsistence payments and small benefits. The small benefits that hopefully some of you are paying or are receiving at the moment. Around Christmas time. This was introduced without any consultation. So the reason this hadn't been communicated to members before is because this hadn't been communicated to us in advance of the finance bill, and it wasn't announced the budget. So it really it came in, as I say, after budget, and it was put in into the finance bill. Now, what we were told here is this won't apply from 2022 anyway. It's still subject to a ministerial commencement order, and we've been told there is going to be a detailed consultation process. Now, I suppose typically you'll have the consultation process in advance of legislation, but here, I suppose, just to get the conversation started, and I suppose maybe perhaps as a signal of intent that this is going to come through, the legislation has come first. But as I say, it's subject to commencement order. So for now, it's very much at consultation stage. So this process should start, I suppose, early 2023, and we will keep members updated via tax news on the development of that process. There has been quite I suppose an animated discussion is probably going to describe it at the various TALC meetings. And you see that from the minutes. What I'm going to do, I'll put in a link in a moment to the TALC minutes where you can find the various minutes. So the finance bill minutes won't be up yet, but hopefully in the coming weeks they will be, and you'll get a sense of the discussion from those minutes. They're fairly detailed minutes, and I know because it took quite a while to write them, so it's definitely worth reading. But it seems that this is the way revenue are going. Enhanced information gathering processes. Obviously, this is going to be quite a burden on employers, particularly smaller employers who will be more impacted by this legal requirement now to actually return these benefits annually or monthly. I suppose it'll remain to be seen the reporting periods, but we have communicated that there will be, I suppose, a disproportionate burden on certain employers. Just by the nature of it. And we also communicated the fact that these benefits, I suppose, were the exemptions from the process of not reporting these, shall we say, is in place because they are small and because it seemed efficient. And also the fact that you have to keep records if you want to claim any of these small benefits, certain of these benefits, you have to keep records, and typically, most of us do, and anyone who doesn't, obviously that causes an issue down the line, because if revenue come knocking, you have to produce records. So look, we'll keep you updated on that, and it'll just remain to be seen, I suppose, how that reporting process actually looks in practice, because the consultation process hasn't started. I suppose at this stage we can say it isn't going to apply for 2022, and when it does, we can't give a definite answer as to when it will apply. But the consultation process must happen first, and we've been given assurance that will happen. So next, on to SARP. I just want to mention a significant change to the SARP process. So for anyone on the call who has submitted a SARP claim, in recent years, you obviously have to have the SARP 1A form submitted within 90 days of the employee's arrival, or the person's arrival into the state. Now, there's obviously that can create an issue if you haven't received the PPSN, or if you haven't yet applied for a PPSN. So typically what was included, it would have been a note to say, please see attached SARP 1A form, emergency tax will apply. We are applying for a PPSN, and we'll provide the PPSN ASAP once received. Now, the new requirement is that the PPSN will actually be a prerequisite to a SARP claim. So in order to reach that 90-day cutoff, because after 90 days you simply cannot make a claim. It's a cliff edge for SARP, to keep that in mind, but you need to have the PPSN. So again, there has been quite detailed discussions on this. What we said to revenue is that, look, typically there has been instances where PPSNs have not been processed for up to 6 months apparently. Now I haven't have personal experience dealing with SARP claims or applying for PPSNs, but again, this is the feedback from members and from the various bodies. So it's not just accountants, it's the members of the other bodies, the lawyers and the ITI and the various bodies, right? So and what we've been told is the Department of Social Protection have gone on record to say that they have been given significantly more resources since January of 2022, January of this year, and that processing times in most districts are down to 2 weeks. Now, on that same parliamentary record, it said, I think in Cork, Sligo, and some other places, it's maybe at about 4 to 5 weeks still. So, you can do the maths there in terms of reaching the 90 days. So, I guess what's important now is that updating your SARP processes such that you start applying for a PPSN well in advance of an employee's arrival into the state. There is a slight complication there that we've made known to revenue, in that some districts require a physical representation at the particular office. So obviously, applying for a PPSN in advance won't be possible in such instances. But just to keep in mind, if you are encountering issues around physical presentation, please feed that back in, because we can feed that to revenue and the DSP to get some sort of agreement in these circumstances at the very least to process PPSNs. But this is a significant change, so please keep us updated on your experience with this. Quickly on to the R&D tax credit. So the R&D tax credit has changed quite significantly as a result of changes required as a result of OECD Pillar 2. This is the Pillar 2 is, you might have heard the talk around this new minimum corporate rate of taxation, this new minimum effective rate, this global minimum effective rate of corporate taxation. So that's at 15% now. And while Pillar 2 hasn't yet been implemented, we need to start putting in the groundwork to be able to implement Pillar 2 fully and efficiently. And one requirement is the R&D tax credit had to be the repayment of the R&D tax credit had to be realigned, shall we say, with Pillar 2. So now it's repayable over 3 years. So this should make actually life a bit more straightforward. When the understanding is that the R&D tax credit can still be offset against your corporation tax liability, but the changes affect the repayable portion of the credit. So how will this benefit SMEs? Because for many on the call, perhaps you're working predominantly with SMEs, and you're thinking, well, why now does the state of play have to change just because of a handful of companies in scope of Pillar 2? Well, a good measure to keep in mind for SMEs. So say if my repayable credit after offsetting my CT liability works out to be 20 grand. Well, now rather than having that repaid over 3 years, you can request that 20 grand repaid in year one. So it's up to 25,000 can be repaid in year one of any claim. Anything above that will be repayable over 3 years, 50% repayable in year one, with the balance paid in years 2 and year 3. I think for SMEs, that's going to be quite a useful cash flow benefit, in that you will be able to make that year one claim of up to 25 grand. And, there's other changes as well in terms of pre-trading expenditure, which may be useful. So there are going to be obviously cash flow impacts of the changes to the R&D tax credit. Again, in the link I shared there on the at a glance finance bill, we dig into the detail a bit more. But again, good to keep that in mind in discussions with clients that may be claiming. We have put out a detailed consultation earlier in the year, suggesting certain key changes to the R&D tax credit to make it more I suppose attractive to SMEs, and we're going to continue pushing that, because it really is a useful credit. But we're aware of some of the difficulties for SMEs claiming the credit. So hope, as I say, it's nice to see some development towards making the credit more useful to SMEs, and I think that 25,000 euro year one opportunity to claim is certainly one thing to keep in mind. There are transition rules as we move from the old repayment rules to the new for 2023. Again, more detail is included in our at a glance bill, finance bill document there. And just on the rental tax credit, to say quickly here, conscious of my time, but again, I think it's important that we just went into the detail of some of those measures there. But the rental tax credit, keep in mind, so if you're renting, certainly the likes of myself and people in my go are delighted that I can claim €500 in January for 2022, and I'll be able to claim €500 each year until 2025. For I suppose the two measures I'd like to just highlight are if you have a principal private residence, but you need to rent an apartment. Say if you're like myself in Cork and I decided I want to rent an apartment, and if I was owning in Cork, say, and I wanted to rent an apartment in Dublin so I could get in nice and early for these talks every Friday, I would say I could still claim the €500 repayable credit on that rental property still, even though I have a principal private residence, I have my own dwelling. If I'm renting for work, I can claim the credit as well. So good to keep that in mind if you're in that cohort of people that are required to rent to work. And obviously with the way the housing market is, we're not going to go into that. We're all blue in the face from hearing about that at the moment. But certainly if you are required to rent, you can claim the rental tax credit. And if you're jointly assessed, both partners can claim the rent credit if you're both renting. On the student tax credit, I imagine there's at least a handful of people on the call here who are paying accommodation fees for their children who are in third level education. They need to be in an RTB registered property to make a claim. So if you're renting, if your child is renting from their friend, and that in such a scenario, they do not need to register for the RTB, but it's a policy decision that a claim can't be made for the student rent credit, we'll call it in that instance. And again, I guess the idea being you may be getting a favourable rate. Whether that's true or not in practice, obviously is going to vary, but it's been a policy decision from Revenue that in that instance where you're paying rent on behalf of a child, if you want to claim the rental tax credit in that instance, the property must be RTB registered. So just to keep that in mind, it's a slight technicality there, but an important one, because obviously it will mean that you can't make the claim. So just quickly on talc, I want to throw in one more link here to talc. So this is a link to the minutes from the various talc meetings. Now, look, there's an awful lot of detail there, and I'm not suggesting that you go through them all, but certainly, for people on this call, definitely the talc collections minutes are going to be very useful. Talc audit, there's quite an awful lot of information in those minutes, and a lot of time is put into compiling those minutes and really including key details. So I think I'll share it again now at the next update. I'll include a hyperlink into the slide, so that's just an oversight on my part today, but I will include it going forward, so you'll always get that link. But as I say, those minutes tend to be updated. They should be updated regularly following agreement of minutes at the various meetings. Just a few things to mention from we'll say the recent talc collections. Revenue are happy with LPT. They seem to be at 93% return compliance and 97% payment compliance. Revenue still want it to be better, of course. They're not happy until it's 100%, but it seems that the LPT process is going pretty well. To mention on the debt warehousing scheme, you still have until 1 January or 31 January 23 to make a claim, or if you have if it turns out that you have any liabilities within the debt warehousing period that were previously undisclosed, if you make a disclosure of those liabilities now, you can still get the benefit of the debt warehousing scheme. And just quickly to mention some of the pieces from just at yesterday's talc direct meeting, there was further discussions on the matters with EPSWT and the GMS contracts. Now, this has been ongoing, but what Revenue have said is it's not an EPSWT issue. It's in fact an issue between the HSE and the treating doctors. So the conversation should be happening in the coming weeks, a conversation between the Department of Health, Department of Finance and Revenue to consider how the contracts or to consider how this matter can be resolved quickly and efficiently. We're aware this has been ongoing and it's causing quite a lot of difficulty for practitioners, but just to say we're continuing to push that with Revenue, and we're hoping following those conversations in the coming weeks that some sort of resolution can be arrived at. So Yeah, just conscious of the time there. So look, if there are any particular queries, please do contact me. I see a couple coming into the chat there, and I think we can get to them later on, Colin. If that's right?
Absolutely, yes.
Just
Yeah.
conscious that I've certainly run over my 20 minutes here. But as I say, look, check out the at a glance financeable document, and do check the minutes of talc. Every so often, just have a glance for some of the issues raised there. So I think I'll leave it there for the tax update for now.
Gerard, thanks very much. As ever, you gave a very comprehensive update there. Thanks for all those links as well to the different minutes. So lots of materials to go off to read. I know when I go read through the talc minutes, they're very, very detailed too, and lots of different things happening in your interactions there with revenue. And yeah, you're not wrong. The TBESS is definitely getting the actual attention, and there's a lot of different questions. Some you might be able to answer, some are very detailed. You might have to go away and come back again, and might be something for further emails. But listen, a great actual tin. Now, before we go to a quick message from our actual sponsors, AccuVest, and from Damien Cooper, I know we have a couple of questions there coming in just for practice consulting. And so, Chris, you can be lining up Damien and AccuVest's actual video while I'm answering these. One here, and it goes back to my own RBO actual update here. Gerard is asking us, our practice is exposed now because they can't do the actual checks back to the RBO for a new client. But first of all, Gerard, we imagine, as I mentioned, I think this is only going to go on for a couple of weeks, as I say to you. This is not, I imagine, going to go on for months and months and months. It's not ideal, quite obviously. But again, as I say to you, when the RBO is reinstated, there's nothing stopping you then. And even though you have actually, this check was never going to stop you taking on the client or not. It was only making a report to the RBO for an update. It wasn't an issue that would stop you taking on a client, whatever like this. You could still actually do the check when it's reinstated, the actual register, and then actually make the report if it is necessary. That'd be my approach in a Cornell. Again, I know this is a situation we'll have to see how it evolves, but that would be my pragmatic approach there. So hopefully, Ger, that gives you some assurance. But quite obviously, Ger, you cannot actually check against a register that you can't access, and nobody can expect you to. So it's not ideal, but no, you can't be held to blame for that.
Though it would appear that you can access it this morning, even though they don't want you to. But yeah, look, no, I mean the checking of the register was never, you were never allowed to rely on it anyway as a know your client check as such, as a verification check. So that's it, because obviously it's the information itself isn't checked as it's put in. So it doesn't have the same standing as checking a passport or whatever. So anyway, that is that. Somebody else was asking us about a link to how you get the voucher to claim the reduced cost for our what do you call it?
Our actual ISQM resource pack. You contact practice members basically. So if you actually click to the link that I had there in my slide, it'll carry you to the actual link to purchase the resource toolkit. So you contact practice members, the same address. You actually get the emails from us on the actual toolkit, or actually on the webinar that you've joined here today. And then our colleague Bernie will get back to you with the actual the discount, and then you can actually then apply it and so on. So hopefully that all makes sense to you. Conal, are we any other questions before we go to AccuVest?
I don't think so. I think we should go to AccuVest. We are behind time.
We are. As I say to you, but again, it's been a lot happening the last couple of months, and so we have to keep up to date. Listen, Chris, if you're good to go, I think Damien has a message for a couple of minutes, and we are delighted to say always have Damien's support and have the AccuVest team support as well. So listen, click, and hopefully we'll be able to get Damien here.
Good morning. I'm delighted to be here to give you a brief update on markets and AccuVest's view of the outlook from here, in the hope that it will help you in your discussions with your clients. Since we last spoke in early October, the economic outlook has continued to get worse. The Eurozone is expected to experience negative growth in Q4 and probably to be in recession in 2023. Despite these declining economic conditions, central banks have continued to hike interest rates in order to get inflation under control, and are expected to continue doing that in December and probably into 2023. Inflation has remained high. However, the decline in the rates in the most recent releases in October in the US and November in the Eurozone has been taken as a positive in markets, with equity markets having rallied considerably through October and again in November. That said, it has been a very, very difficult year for investors, and most investors will be down considerably in their investment portfolio. From here, the outlook from an economic perspective is not particularly optimistic, although, however, we would hope that it will be better from an investment opportunity. Recessions are not necessarily particularly good environments for investors, but opportunities do present themselves and markets look forward. The first thing you need to do is make sure that you have an understanding of the portfolio that you would like to have that is capable of delivering on your investment requirements. Then you need to have an understanding of the assets that you hold in your portfolio. It's a good idea to have some diversification in place, and also to make sure that you have enough liquidity to deal with any unexpected requirements that you might have, and also to allow you potentially to avail of opportunities that may arise and do arise during market downtimes. From that perspective, it's a good idea to have some cash for your rainy day fund, and then also to be able to avail of those opportunities. It's always important to make sure that you're happy with what you're paying, that you know what you're paying, and that you're getting a good service for that. There's no point in paying 5-star prices for 2-star service. And you need to make sure that you know what you're paying and that you're happy that you know who you're paying it to. Being informed about your investments and having a trusted advisor on your team who will help you will allow you to remain invested with confidence and to stay calm during what are likely to be volatile times ahead. Good to be agile and alert through market ups and downs, and look forward with confidence to calmer times ahead. If you or your clients have any questions in relation to investments, please make sure to contact me or my colleagues in AccuVest either directly through our website accuvest.ie or through the Practice News team. I look forward to working together through what will hopefully be a happy and prosperous 2023. Thank you for your time and attention.
Some very good tips there from Damien on the well, it's, I suppose, a very volatile investment market at the moment. And yeah, look, if you do have any questions or even questions that you think Damien and his team could advise your clients and so on as well, you can find them on the internet, and there's actually links and so on as well. And we'd be happy to put you in contact too. Listen, Conal, moving on. And as you said, yeah, we're a little bit behind, but not too bad, as I say to you. For our main guest speaker here today, we're delighted to have Elaine. And I know yourself and Elaine are going to have a chat about a very interesting topic, buying and selling practices and incorporating too.
Absolutely, we are indeed. Elaine, you're very, very welcome.
Thank you very much for having me. Good morning.
Now, you're a partner in Reddy Charlton, based in Fitzwilliam Place here in Dublin. And looking at your CV here, I see that you're involved in corporate transactions, partnership law, commercial contracting, and intellectual property. And what we were discussing when we spoke last week was the whole area of incorporation of practices. So, are you seeing many practices continuing to incorporate at the moment?
Yeah, I think so. I mean, I think you probably know the stats, amongst your members as to the numbers incorporated versus partnerships. I think certainly any new practices setting up are all, starting out as corporates. Those that were running a sort of dual partnership and company structure where there were certain restrictions around certain types of work are probably migrating all that work now into the corporate, seeing as those restrictions are no longer being. I think probably, for a lot of practices, it's the sort of getting around to it. They probably know they want to do it. It's the sort of the time and resources. It's like everyone, you're busy doing the day-to-day, servicing the clients, and sometimes you maybe neglect to apply your mind to your own practice. So yeah, there's an element of it. If it ain't broke, don't fix it. Yeah, this is a big project. Do we have the time and resources? Yeah. And
absolutely. And I suppose, like a lot of things, there's never a good time to do it. it is a big project.
Yeah.
There's all the steps you got to do, the changing, if you have audit registration, changing that, new engagement for clients. You've got to cancel the old one if necessary.
2P, new bank accounts, headed paper, all of that, you know, so it is a bit of a headache, and it does take, you know, you do need to sort of have the time or really, you know, make a plan that you're going to grasp the nettle and do it.
That's, and to, you know, to treat it as a project, assign responsibility, delegate responsibility, all of that, all things that you would do.
And I think in terms of you know, for larger practices with a lot of partners and all of that, sort of replicating maybe what you have in your partnership agreement into your shareholders agreement, and we'll talk a little bit about that, but that again is another sort of big part of the project, and trying to get consensus amongst everybody how that's going to operate, and you know, that takes a bit of thinking and a bit of planning.
Absolutely. So I mean, and speaking to a lot of so smaller practices, people who are in partnerships at the moment, most of them wouldn't have partnership agreements, but when you're migrating to the corporate structure, is that an opportunity to put in place an agreement between what are now the directors of the company? Is that what you see?
Yeah, absolutely. And I think like a partnership is a bit more nebulous. It allows for a lot more flexibility, and you know, particularly if there's only sort of 2 or 3 of you, you know, you're doing everything by consensus generally. A company honestly has, you know, very rigid rules and structures in terms of how they operate, and there are, I suppose, differences that, you know, really do need some thinking when you're moving from one to the other. Obviously, the company is, you know, a separate person to the individuals, whereas that's not the case with the partnership. So that, you know, as a result, you know, the partners now will become employees. They'll cease to be self-employed. There'll be, you know, there are advantages to that. Of course, you have all the protections that employees have that you wouldn't necessarily have had as self-employed, such as, you know, maternity leave, rights of unfair dismissal, all that sort of thing. But it does change your status and sort of what you can and can't do. But, you know, generally partners or former partners moving to a corporate, you're going to have sort of, you know, different roles, as you'll be a shareholder, a director and an employee. And you need to think about, well, you know, what is the interaction around those? What does that mean, you know, from the day to day? I suppose people would be predominantly concerned with, you know, what does that mean in my pocket? You know, and look, your members would be more familiar than me with the sort of the specifics around taxation issues, but certainly around structuring it, it does need some thought in terms of, you know, how are we going to distribute profit, and is that going to be done by way of employment bonus? Is there, you know, how are we going to hold the shares in the company? Should that be in a sort of personal holding company? You know, are there opportunities around that where, you know, you mightn't have the same flexibility to sort of change it as you go along as you would have had in a partnership arrangement. I think one of the other difficulties is bringing people, you know, the sort of entry and exit of partners. That can happen seamlessly in a partnership agreement. It doesn't have the same sort of taxation implications. But because now the company is a separate entity with a value, to give somebody a share of it or to sort of, you know, cash out that share at the other end can have taxation implications. So it does need a bit of thinking in terms of how are we going to do that? How do we sort of mitigate against the tax? How are we going to fund it on an exit? Yeah. So there's lots to think about.
And indeed, some of these things aren't talked about at all in partnerships. It's you know, it's a tricky conversation to have, and sometimes people deal with that by not having it. Whereas it seems in a company, you do that at your peril. That, you know, these things do need to be much more nailed down, because somebody has to ultimately leave, take value perhaps, or not take value at a certain defined amount, and that's going to have specific tax implications for this separate entity. So yeah, absolutely. There's just a lot more thought. I mean, I don't see much journey or direction practices going the other direction from company.
I haven't seen any. No, it's all, I mean, look, there's the obvious advantage of the limited liability protection, But yeah, it does. And look, I think whether you're happy to remain as a partner in a partnership or you want to incorporate, I think it really is worth thinking about an agreement. Because sometimes, I suppose I always say that your whether it's your partnership agreement or your shareholders agreement, it's like your prenup. You hope that you'll never have to look at it again, but the exercise of applying your mind to the questions means that everybody's expectations are managed in terms of what to expect and where we're going and what we're doing. It's also worth, they do need to be reviewed periodically though, because, and I often see this where there's issues and it's a partnership agreement or a shareholders agreement that was done 15 years ago. The sort of original authors of that aren't even any longer in the practice. The way the practice operates has, evolved over time, and the agreement now is no longer fit for purpose. So, that probably is something you should diary for every, 5 years or so, just to let's have a look. Does this still work for how we're operating today?
Yeah, absolutely. And what I would say to people, and somebody in the chat, somebody is asking for an alternate agreement, and we'll talk about that later. But I guess the first thing to do is to have the conversation and put it down in your own words and what you want, and then subsequent to that, if it needs to be more formalized in a legal document, so be it. But the first case, have the discussion, get the points down, get them down onto paper, and if that's your to-do list from today, do that. And then,
and as you say, it can be a tricky conversation, but it's a much easier conversation when you're getting on with somebody than when you're falling out with somebody because you have a sort of different expectation of it.
That's no harm to crystallize the expectations.
Yeah.
So look, I mean, that's certainly food for thought there, and a to-do point for people. If you don't have an agreement, certainly begin that discussion. So there, the other matter, and I know time is against it, we could come back to one or two of these things if time allows towards the end. But the other thing which we said was worthy of discussion is certainly the whole area of buying, selling, merging of practices, where you do help accountancy practices and other professionals in this area. I suppose the way that I phrased the question was, if somebody comes to you and says, I'd like to sell my practice, in your mind, what are you thinking? Oh God, I just hope this person has this one thing done. So what is the one thing that they should have done before they come to you, maybe years beforehand, to get their practice?
Yeah, well, I think quite often people come to us and they've sort of have a heads of terms that they've signed up, and you're like, pity, you had come to us a bit earlier, or if you knew this was in the offing. One of the sort of, there's a few key things that sort of delay and make sort of, moving the transaction along quickly is obviously the due diligence is a big part of the work of the transaction. But the more sort of prep for that you can have done in advance, if you do know that this is likely to be in happening in the short term, is to really have done a sort of a legal audit or an internal DD audit to see where are we at, what do we need to maybe update, improve, even just putting your hands on the documents, having them available, having them sort of centrally collated so that they're easily transferable over to the buyer's team when they're looking for it. So things that are often sort of, neglected might be employment contracts. Not everybody has their written contract, or they're out of date. Things like GDPR policies and procedures. If there's property in the business, so commonly you'll find, say, one of the shareholders or one of the partners owns the property, but there isn't really a formal arrangement in terms of the lease to the practice, things like that. So regularizing those sort of arrangements. And that means that once you actually get down to the transaction, that due diligence process can happen more quickly and efficiently, and it's a lot easier to do in stages when you have the time, rather than when you're under pressure trying to deal with the transaction.
Absolutely. We've got any questions come in so far on this? Now, someone says, could you put on a CPD course next year dealing with the legal and tax issues relating to incorporating a practice? I'm sure we can do that. I think that's something that we could certainly do. So we'll have a think about that one. Is there a template shareholders agreement CAI resources website? these things, my experience, tend to be fantastically complex shareholders agreements in terms of trying to put together a template, one that suits all. In my experience, I really encourage people to go the other way, which is to put together your plain English agreement first of all, and then build that up into an agreement. It really,
but it's something I think in terms of maybe a resource, and be happy to liaise with you on it, would be maybe a checklist of issues to think about. You know, and because they will be very much dependent on the specifics of the individual practice, how many shareholders there are, you know, what their sort of, I suppose, stage of career is, you know, what are the aspirations for the firm in terms of growth or sale and all of that in terms of how you package it.
Absolutely. So look, and listen, we'll take all these points on board. If this can be done, we'll certainly look seriously at doing it. I know something we looked at before, and just the sheer complexity of trying to put a one-size-fits-all thing in place. At that point, when we last looked at it, it was just then it was just too difficult then. But let's see if we can't look at it again. Now, okay, looking at the transactions then. In my mind, I mean, you've got the classic idea for accountancy practice anyway, that the price of an accountancy practice all the years was 1 for 1. In other words, the recurring fees, the practice, that was the value of the practice. But of course, there's a lot of elements to a sale. There's the price that's struck. There's the earn out. I mean, you know, you're paying it over a number of years, perhaps. And then there's a clawback idea where if all the clients don't transfer or fall away in time, there is a certain clawback. So obviously these are all interact with one another. What do you see there in that?
So these provisions can be wonderfully complicated and complex or simple. And look, it really, again, it depends on the buyer's assessment of the business, the risks perhaps they identify, but generally, as you say, there'll be a value put on the business based on recurring income, and that will usually be paid over a number of years. There'll be a lump sum, then sort of deferred payments in sort of each of maybe for 3 years, generally 3 to 5. Sometimes it seems 5 is quite long. And that will be subject to adjustment. It's on the assumption that recurring income will continue to be maintained at the same level. And so the deferred consideration payments will be adjusted downwards generally if there is a change in that recurring income or turnover target. So things to think about are, there's always going to be an element of attrition, and clients fall away, but new clients come in. So if the sellers have clients don't continue after, they may not like the buyer, or they, just in general life, they move on. Can you replace those? So is it new business brought in after the sale by the seller's team? Will that be counted towards that turnover? If there is business that has been referred in by the seller's team but done by the buyer's team, is that going to be counted towards the seller's target? So the sort of the definition of the turnover, or what's going to be included in that calculation, is really important to think about. And I suppose equally what's excluded. And because that's where the that's the figure that the adjustment is going to be based on. So you really need to sort of tease that out in terms of what's in and what's out, because if it's just based on the clients that transfer on day one, there's always going to be, as I say, an element of attrition, or clients that move on. So just need to figure that out. The claw,
go on. Yeah, sorry, no.
I was going to say the clawback. Then again, that it can be done in loads of ways. Sometimes it's just a euro for euro, to the extent you don't meet the target. It can be sort of less than a euro, or it can be more, depending. Again, it'll depend on the profile of the firm and maybe the risk that's that the buyer has identified in relation to it.
But it seems to me that if they a straight euro for euro clawback, in other words, for every euro that of client income that falls off, that we'll pay you a euro less ultimately, in that case the seller is taking all the risk. So I think people need to probably recognize that one, and that that's great if you're a buyer that the seller has taken all the risk here, but that's not necessarily written in stone that the seller should take all the risk. So you mentioned clawbacks of less than €1 for euros, which is
yeah, you do see that sometimes. The other thing I suppose to build into the agreement is, you know, as the seller, once you've been sort of taken over by the buyer, you don't have the same control, particularly if it's, you know, sometimes it'll be a sort of a true merger where the sellers will come into ownership of the buyer, and they'll sort of you know, still have a you know, ownership type control or partly at least. But you need to build in things like you can't have the buyer sort of starving the target business of either, you know, working capital or staff or whatever it may be. So there needs to be a commitment from the buyer to support the seller's business and seller's team in allowing them to achieve that. And look, it's win-win ultimately. You know, if the sort of the business is maintained or grown, that's, you know, that's a win for the buyer. So that there shouldn't be any real conflict about that, but it is something to build into the agreement and sort of think about the protections from the seller in that respect. Absolutely. The other thing I suppose to think about, and it's important for both buyer and seller on that, is key staff, making sure they're adequately incentivized and, you know, that they're going to remain on board notwithstanding the change, particularly if there's going to be a change of location or, you know, it's going to be a change of culture. You know, hopefully the two teams will merge well, but, you know, again, with a sort of a merge of two different entities, it will always be employees who may not sort of like the new arrangement or whatever, who will fall away, and so you want to make sure that your key team are going to stick with you for that period. And
it was ever thus, but even more so now. And I think practices might, you know, just might reflect, especially people who are contemplating selling, that what a buyer is probably actually interested in is probably at least as much the team as the block of clients, possibly more. But I mean,
professional services, you know, as you know, it's all about the relationships and, you know.
Absolutely.
So client list is all very well, but if the people they're used to dealing with and the, you know, the trusted advisors that they've had are gone, they don't necessarily have any loyalty to the new owner.
Absolutely, and nobody owns a client and nobody owns a staff member. So it's worth reflecting on that, and you know, and dare I say, staff members are at least as likely to move in these situations. So
certainly in the current situation, I know particularly in your industry at the moment, recruitment is extremely difficult, and keeping staff and all of that. So I mean, you know, proper, you know, insofar as you can protect yourself in your contracts of employment by having a sort of a you know, a decent notice period requirement, so at least you have a bit of, you know, room to sort of manage the transition if somebody is moving on, or non-solicitation clauses in your contracts of employment. Now they're, I suppose, notoriously difficult to enforce, but they certainly do have you know, a deterrent value, and you know, so I suppose the thing with non-solicitation clause or restrictive covenants in general is they can't go any further than is necessary for the employer to protect a legitimate interest. Absolutely. So you couldn't, for example, stop an accountant working as an accountant. Another accountant in the market isn't really going to impact on your business. But certainly if they take your clients, that is a legitimate interest that you want to protect. So you'll have you ought to have a non-solicitation clause in the contract to stop people taking. Now, the difficulty with non-solicitation, of course, is how do you know whether they were solicited or the client went anyway because of the, you know, relationship that was naturally there. The client says, well, I'll follow you, rather than you know, encouraged me to come.
Absolutely.
So that is, I suppose, a frailty. And then you do see sometimes non-dealing clauses, which says you can't actually act for any of our clients, you know, for the period. And they're sort of fraught with difficulty in terms of enforcement, because that in effect is a restriction on the client, which is, you know, the freedom of the client to go where they want. So while they have their limitations, they are absolutely worth having in your contract. And certainly for a new employer won't want to get involved in, you know, get embroiled in it if they're, you know, if there's a question that sort of clients have been solicited contrary to a restriction that's in the contract.
Very, very interesting. Listen, that's there's a lot to think about there. I know that it's something that a lot of people are interested in. Obviously, you can only sell your practice once or merge your practice once. But you could certainly, a lot of practices are out there would be interested in buying. It's an area which, as I say, people want to know what their practice is worth, if you like, even if it's not an immediate concern of theirs. So I think it's an area of great interest to members, and I was with a few questions coming in.
We do indeed, Conal, as I said to you. I'm not sure. Some of them will we try to handle now, or I think some of them might be practice specific on valuation and on the market in general. I know we do have consultations with people at times. What do you think?
Yeah, we certainly do talk to people. Somebody says, what are metrics commonly used for valuing a practice? I've seen people talk about 1 for 1, and then it's up or down from there. It's a readily measurable number as opposed to measuring recurring profits or something. Elaine, do you see anything similar?
Yeah. I mean, I think the valuation metrics now are probably more your bailiwick, but certainly it's generally based on the recurring income, and you might see a bit more than one on a very very good practice with sort of good client base. But it really, I suppose, it depends on how attractive the practice is, and I suppose the nature of the clients that are in it.
Absolutely, yeah. Okay, so it's worth thinking about. Someone asked, are there many buyers? I think there's a lot of potential buyers out there. My own feeling is this is a very personal thing. People are better off approaching people that they know in this. It's funny, people are most people in practice would like to purchase a practice in theory, but when it comes down to it, they want to purchase the right one. And likewise, and the same goes for sellers. So I mean, I recommend that people network a bit, talk to people, and engage with practices who you could ultimately purchase or sell, or sell.
Yeah, I think the culture, having a sort of where you think there'll be a good fit in terms of sort of profile and people and all of that. And I know certainly in our game, I know you hear of people selling practices, but the principal of that practice is known to be a sort of a difficult character, and people don't necessarily then want to, while they might have good clients, it's not going to be able to work with that person, even though the work that they have is good. So there's definitely, there needs to be a good fit, and you need to sort of plan for that sort of, integration and stuff.
Absolutely, because it is a people business, and just to say, so hopefully that answers your question. What's your experience where the buyer is a management team? Okay, right. My experience, the fact is the buyer is coming from inside the organization does tend to depress the price that is being paid, because they already, in a sense, control the goodwill to an extent. And also it's known that they don't really have any access to capital except what they've earned themselves within the business. And you have the loyalty and the personal relationships with the people selling. So there's a degree of that. It definitely doesn't tend to increase the price, the fact that it is an internal bid. Once again,
it simplifies the process, I suppose. I think because the people are internal, have familiarity with it, and if they're already sort of senior employees, they probably have access to a lot of the the financials and all of that. They know how it's run in terms of its compliance and culture and all of those sort of things. So from the sort of pure transactional point of view, that definitely simplifies it. But,
very good. Listen, hopefully that answers the questions. I think it's really interesting, Elaine. It's great to talk to you. It's an issue that's of interest to so many people. I think Jeremy is there. He's looking at me. He's giving me daggers looks now, I think, at this stage. I think we've gone way over time on this. But as I say, it's so apologies for that.
No, it's been a very insightful, I think, conversation there. There's something, you could be here for 2 or 3 hours, and as somebody mentioned, doing a webinar on the tax and the legal implications of incorporating your practice or buying and selling. But perhaps we'll look at that, as I say to you, into the new year as well. I know there's various different questions there and various different looking at checklists, or I think really, and I'm sure Elaine, you'd agree, every practice and particularly two practices come together, they're unique. So yeah, I think you do need to get legal advice. In some reasons, people ask us to give us just a template agreement, and we can do the same with an alternate agreement as well, for that matter. Very difficult because the scope of the arrangement and the actual practices themselves, the nature of them and the requirements, you do need to tailor for. And there's the chance, I think, with a tailored agreement, they'll just take the template, sign it up, and it just won't be appropriate for them.
No, and that can nearly be as bad as not having one at all. Sometimes if it doesn't suit what you need, yeah.
Okay, guys, listen. I think we'll say thanks very much to Elaine, and
Thank you.
absolutely, we might work with you again on one or two of the issues raised, and
Sure, absolutely. Happy to help.
maybe see you again to follow up again. Delighted. Thank you very much for coming.
Thanks very much, everyone. Thanks. Bye-bye.
Thanks, Elaine. Well, listen, I think, Conal, and yeah, we're pushing on, but not too bad, as I say to you now. I think the next session up we have is Leontia. And Leontia, I know, has a recording here on all the happenings in the tax side of things in the UK. Autumn statements, mini budgets, making tax digital and different things. I know Leontia's actual talk is it's about 20 minutes long, and it's always very well received, I think, by everyone, as I say to you. UK and Irish, because a lot of people have clients in the UK as well. So Conal, will we go to that, and then we can have, I know Garrod is patiently working in the background, different things too, and we might have a wrap up after that as well. So we will be back, as I say to you, for that. Would that work nicely?
Would indeed. Well, listen, I feel some people will drop off now. So listen, thank you very, very much. We won't be seeing you until the new year. So have a very happy Christmas. And as I said earlier, I'll thank everyone for all of their support for Practice News all year long. I think it's one of the best support things that we do in the Institute, and it's there for you as members. So we're delighted to be able to help you as much as we can. Thank you very much for all of the interactions, also the questions, the comments, the notes in chat, the hints, and all of those things. And we do our best to answer as many of them as we can in the time, but equally we're constantly really try to, and usually fail to keep it within time. But as I said, there's quite a lot. It's a tricky job, this accountancy business. A lot to know. It's
very broad, Conal, and particularly now today when you have things like the RBO evolving situations and alternate and so on. We try to answer when we can, but that does take time. And there's some things like that you could have a whole day session on it, and you still wouldn't get to the bottom of it. So be aware with Practice News, and as I say, that's just the nature of it. So you do have to give it the extra time, and the recording is there too. But listen, I think probably if Chris, if you're there, if Leontia's recording is good to go, that would be great.
Hi there, and welcome to this Practice News December 2022 tax update with me, Leontia Dorn. For those of you that don't know me, I'm Leontia, the UK tax specialist with the Institute's Advocacy and Voice team. In this short recording, I'll be providing you with a brief update on what's been happening since our last update at the beginning of October, and what we as an institute have been working on for you, our members. So I suppose I just want to start by saying, wow, what a few months and a year it's been for UK tax. Since our last update, we've had the third Prime Minister of 2022 and the fourth Chancellor, followed by several fiscal announcements and major U-turns, culminating in last month's autumn statement on Thursday, the 17th of November. And that's not all. It's on top of all the other fiscal announcements made this year in 2022. So let's take a look at what we're going to be covering in this short update. We'll be looking at the September 2022 mini budget announcements that are still in situ and the major U-turns that were announced. We'll then move on to look at key announcements from the recent autumn statement. Two recent pieces of lobbying work will be focused on in terms of Northern Ireland. They are quite specific to NI. And then we'll move on to what's been happening with Making Tax Digital for VAT, and finally Making Tax Digital for income tax. So let's start by looking at the main September 2022 mini budget announcements, which remain in place and which were not subsequently reversed by new Chancellor Jeremy Hunt. And I stress that these are only the main elements which remain untouched by the new Chancellor. There are others that you can see coverage of on our website. Firstly, the reversal of the 6th of April 2022 1.25% increase in national insurance contributions. This reversal was kept in situ and took effect from the 6th of November 2022. And in addition, the 1.25% health and social care levy, which was to be introduced from the 6th of April 2023, is confirmed as not proceeding. In addition, the permanent increase in the annual investment allowance limit to £1 million remains undisturbed, as unfortunately does the closure of the Office of Tax Simplification. Now, in terms of the increase in the annual investment allowance limit, which remember provides 100% capital allowances for certain expenditure, this was recommended by the Institute in our response to the Treasury consultation earlier this year on potential reforms to the UK's capital allowances regime. In addition, the changes made to the stamp duty land tax residential property thresholds remain in situ. Now, these all took effect for purchases of residential property in England and Northern Ireland on or after the 23rd of September 2022, although these are no longer permanent as a result of the recent autumn statement and will end on the 31st of March 2025. So, we also had some quite significant U-turns made after the mini-budget as follows. Firstly, the abolition of the 45% additional rate of income tax is not going ahead. And we'll also see there was a major announcement in respect of this in the autumn statement. The changes to the rates of corporation tax are proceeding as planned from the 1st of April 2023 after being reversed in the mini-budget. This legislation has already been acted in Finance Act 2021. In addition, legislation in the form of regulations was also recently published that sets out how to work out if there is substantial commercial interdependence between companies when determining if they are associated companies, and that's because the number of associated companies replaces the concept of related 51% group company for several corporation tax purposes from the 1st of April 2023. There will also be no cut from 20% to 19% for the basic rate of income tax. The basic rate of income tax will stay at 20% indefinitely, as of course will gift aid as a result. The 1.25% increase in each of the rates of dividend tax for income tax, which took effect from the 6th of April 2022, are staying in place. So that's 8.75%, 33.75%, and 39.35% for your basic rate, higher rate, and additional rate taxpayers. We also had the news that the reversal of the IR35 of payroll working rules from 2017 and 2021 essentially are staying in place and are not being repealed. There will also be no new VAT-free shopping scheme for non-UK visitors to GB, although that of course would not have applied in Northern Ireland. And finally, the freezing of alcohol duty rates from the 1st of February 2023 will not take place and they will increase. However, the government did announce recently in its response to the consultation on the new alcohol duty system that from the 1st of August 2023, alcohol duty rates will be based on products' alcohol content. Turning now to the autumn statement. On the 17th of November, against the backdrop of recession and the highest monthly increase in inflation in over 40 years, the new Chancellor delivered the autumn statement. Now, what I'm going to cover now are the key items only. You can read more in the Institute's tax newsletter on the detail from Monday the 21st of November. Under the personal taxes heading, we saw the freezing of many allowances, including the IHT nil rate bands, for a further 2 years. So they were frozen until 2025-2026, and they're now frozen for another 2 years until 2027-2028. From the 6th of April 2023, the threshold at which the 45% additional rate of income tax begins to apply will be reduced from 150,000 to 125,140, costing such taxpayers a maximum of £1,243 in additional income tax every year. In the context of non-savings income, this reduction in that threshold will apply to taxpayers in England, Wales and Northern Ireland. However, for savings and dividend income, the reduction applies UK-wide, including Scotland. Currently, Scotland's top rate of income tax is 46%, and this continues to commence from 150,000. So the question is, will Scotland reduce this threshold in line with the rest of the UK in its Scottish budget? and that's due to be held on the 15th of December. In the area of dividend tax, the level of the £2,000 dividend allowance, which applies UK-wide and taxes the first 2k at 0%, will be reduced from £2,000 to £1,000 from the 6th of April 2023, and then further reduced to £500 from the 6th of April 2024. And finally, the capital gains tax annual exemption will be reduced from its current level of £12,300 to £6,000 from the 6th of April 2023, with a further reduction to 3k from April 2024. However, no changes were made to the rates of capital gains tax. Turning now to the business taxes heading, the most significant changes were made to the rates of R&D tax relief and in the area of windfall taxes via changes to the energy profits levy that will take effect from January, and a new temporary levy which is being introduced for electricity generators. So the main changes really were made to the rates of R&D tax relief. According to the Chancellor's speech and accompanying documents, there is significant error and fraud in the SME R&D tax relief regime, with apparently the generosity of the relief at 130% making it a target for fraud. So, for qualifying R&D revenue spend incurred on or after the 1st of April 2023, the SME additional deduction is going to decrease from 130% to 86%, and the SME payable tax credit rate will also decrease from 14.5% to 10%. However, the taxable R&D expenditure credit available for claims under the large company regime will increase from 13% to 20%. So according to the government, this particular reform is a step towards a simplified single R&D expenditure credit scheme for which the government will consult in future. So how do the rate changes impact overall? Well, for companies continuing to pay corporation tax at 19% from the 1st of April 2023, the rate of saving for every pound of qualifying SMEs R&D revenue spend will fall from 24.7 pence per pound to 16.34 pence, whilst companies paying corporation tax of 25% from April 2023 will see a fall from 24.7 pence to 21.5 pence per pound. Companies claiming under the large regime, where the rate increases of the RDAC from 13 to 20%, if they are paying corporation tax at 19%, will see an increase in the rate of saving from 10.53 pence per pound, remember because the RDAC is taxable, to 16.2 pence per pound, with companies paying corporation tax at 25% from April 2023 seeing a smaller increase from 10.53 pence to 15 pence. We also had changes to the treatment of electric vehicles, to first-year allowances for vehicle charge points, to transfer pricing documents, to the setting of the rates for company car and van tax until April 2028, and a number of miscellaneous measures were also contained in the autumn statement announcements. Several thresholds are also being maintained, and there is also confirmation of the start date for the UK's Pillar 2 rules for accounting periods starting on or after 31 December 2023. The government also announced that it has decided not to proceed with a new online sales tax. So after the Chancellor's autumn statement, the Autumn Finance Bill 2022, official title Finance Bill 2022-2023, was published. This bill is the first of two finance bills being used by the government to enact most of the autumn statement measures. A further finance bill, probably known as Spring Finance Bill 2023, is expected to be published after the 2023 spring budget, when we normally have our budget. So Autumn Finance Bill 2022 includes the legislation for most of the Chancellor's announcements in the autumn statement, particularly in respect of the rate and threshold changes and phrases. But bear in mind that, as always, the devil is in the detail, so do ensure that you consider the specific impact and detail of the relevant legislation and these announcements in the context of the bill. So turning now to some recent lobbying work. Since my last update in early October, we have made 2 detailed submissions in key areas of particular interest for Northern Ireland. This brings the total of submissions in 2022 on the UK tax side to 14. I now want to highlight some brief points on each of the 2 recent submissions. Firstly, last month the Institute made a submission to the House of Lords inquiry into the Northern Ireland Protocol Bill, and that has now been accepted as evidence by the committee. So we're able to tell you about it. The submission highlighted the uncertainty that the bill is creating for Northern Ireland businesses. It also highlighted that despite the recent one-year extension to the Trader Support Service, a key recommendation of the Institute since 2021, a longer-term solution is still needed to ensure there is sufficient capacity in the Northern Ireland customs intermediaries market in future. Our submission also highlighted concerns in respect of the bill potentially damaging access to EU markets, potential issues arising from the proposed dual regulatory regime, the lack of detail in the bill for different types of goods movements, including groupage, and the urgent need for a reimbursement scheme to be established. A positive but cautious note, however, was sounded in relation to goods movements for the retail sector selling only to Northern Ireland consumers and for parcels being delivered to NI consumers. General comments were also made as follows. No guidance nor accompanying legislation in respect of the bill has been provided for formal consultation. Adequate time will need to be given for any changes to be properly designed and implemented, and this is likely to run into years. And in these uncertain times, businesses also need certainty of HMRC's approach to compliance, so we have proposed that HMRC consider automatic suspension of penalties for at least a 12 to 18-month period. In conclusion, the submission set out that Northern Ireland remains in a political vacuum of instability. The bill further exacerbates this and brings new levels of uncertainty for the Northern Ireland region from many perspectives. Turning now to our second consultation on devolution of more fiscal powers to Northern Ireland. In our response to the local Department of Finance consultation on devolution of more fiscal powers, the Institute does not recommend that the Northern Ireland Executive, if re-established, consider any other taxes for devolution at the present time. The ongoing political instability in the region is a strong argument against further devolution of taxes. However, once re-established, the Executive should instead pursue the completion of corporation tax devolution. In doing so, it should begin by following the prerequisite steps as set out in the Independent Fiscal Commission's December 2021 interim report. A public consultation should also be launched to explore potential mechanisms to mitigate the impact of the cost of Northern Ireland corporation tax via the block grant reduction. In addition, any new executive should also work with the Office of National Statistics, HMRC, and the Northern Ireland Statistics and Research Agency to improve data on tax receipts in NI. And finally, in conclusion, the Institute also took the opportunity to urge all political parties to consider the impact that lack of government in the region is having on public services, businesses, and ultimately on citizens. We hope that through good faith discussions, a mutually agreed solution on the protocol can be reached as soon as possible, which protects peace and jobs, provides prosperity for all, and enables the Executive to be re-established. So turning now to our two last topics, and apologies guys, I've run beyond my normal 15 minutes here, but we're looking now at making tax digital for VAT, and we'll wrap up with making tax digital for income tax. So in the context of MTD for VAT, on the 1st of November, HMRC closed its online VAT portal for most VAT registered businesses unless an exemption is in place. However, businesses that file annual VAT returns are still able to use this until the 15th of May 2023. Now, due to concerns expressed by this institute, a limited relaxation was made available in late October for businesses with turnover under 85,000. If they had not signed up to MTD for VAT in time to file their VAT return due on the 7th of November, they were still able to use the existing VAT online account for that return only. However, they must sign up to MTD for VAT in order to file any VAT returns due after the 1st of December 2022. And that's if they file monthly or quarterly, because they could face a penalty for failure to do so. Businesses with turnover over 85k who have been mandated to use MTD for VAT since 2019 and who were still not signed up are not able to use the online VAT portal and cannot avail of the relaxation that I've mentioned, that limited relaxation. So overall, the closure of the portal means that businesses no longer have to sign up to MTD for VAT. However, if a business has not started using MTD for VAT functional compatible software, i.e. software which talks to HMRC's systems via an application program interface, HMRC is advising those businesses to get that software in place as soon as possible. And they have set out the necessary steps that must be followed in a letter to those businesses and a recent email to Chartered Accountants Ireland, which we will be publishing in early December. Turning now to our final topic, making tax digital for income tax. Unfortunately, there's no update in respect of this because at present it's still due to proceed as planned from April 2024. Now, you might remember from previous updates that in the last few months, the Institute has been attending various HMRC forum meetings on MTD, at which the many barriers to the successful introduction of this initiative from April 2024 were discussed and highlighted, including lack of available software and the limited numbers of taxpayers taking part in the trial. I believe it's still less than 100 taxpayers. The Institute also continues to discuss with the other professional bodies a potential joint approach to government to express our concerns on MTD and tax complexity. A further meeting was held last month ahead of the autumn statement, as we expected there to be some announcement in light of the recent changes in terms of the Prime Minister and his team. So we were giving them some time to make that announcement, and we were hopeful that an announcement would be made in the autumn statement. However, it was silent on MTD for income tax, and just this week, a Making Tax Digital forum meeting that was due to take place was also cancelled. So at upcoming meetings with HMRC, we will continue to reiterate the need for HMRC to take stock of this very challenging timetable for MTD for income tax and revise this to enable HMRC to reconsult with stakeholders. Businesses, taxpayers and HMRC will all benefit from additional time to prepare and the opportunity for further consultation and collaboration. Our key message will continue to be that HMRC should focus on delivering objectives well rather than overstretching capacity and creating a real mess when this is introduced. Overall, we are clear that further digitalisation under MTD is only possible if delivered and implemented in a way that it allows businesses and taxpayers sufficient time to prepare. And finally, this recording just gives a flavour of the key changes and work streams that have been underway in the last few months. Do keep up to date with all the latest Irish, UK and international tax developments through Chartered Accountants Tax News, which issues every Monday. As you can see on the screen, I've also provided details of contact email addresses. And just to wrap up the session, if you haven't already subscribed to Tax News on a Monday, you can find a link on how to subscribe on the slide on the screen. So I just want to wrap up the session by thanking you all for your attention this year and your interest in UK tax, and wishing you a very happy and healthy Christmas and a very peaceful 2023. We'll be doing it all again next year in the UK tax team. Thank you for listening.
And I would like to thank Leontia for, as ever, that a very, very comprehensive update. Yeah, it's been a busy couple of months on the UK tax side for sure, with all the changes going on in Westminster and Making Tax Digital and everything else as well. Listen, on that one, and so we see have a good cohort of people here, approaching 200. I think, Conal, will we go back to if Garrod is still there very quickly? I know Garrod has been very, very busy there trying to answer some questions. Some might say have been impossible for you to answer and you'd need to learn more from the people. But Garrod, as I always ask at this time of the webinar, is there any common themes you're seeing coming from there? I know the TBSS, I think, is one that's evolving at the moment, and but you might have some further thoughts from the questions you're seeing.
Yeah, look, just to mention around eligible trades and the like section. So the legislation, just in the latest iteration of Finance Bill, is contained in section 101. So you'll have to drill into that to get comfortable as to whether or not your business qualifies. But the legislation, section 1 and subsection 101 subsections. 101 subsection 2 A and B are the relevant sections here. So A looks at charities carrying on a case 1 trade, and that's the eligible business. And part 101 2B says it's a case 1 trade or profession. So if you're taxed under case 1 or case 2, then yeah, you can make a claim for sure. So in terms of the businesses where they work, where you're carrying on where the place of work is also your home, there is provision in the guidance as to how to make that apportionment, and I put in the section, I think it is section 6.2.1.4. so if you go through some of the answers there, you see it. But that section of the TBS guidance does say, look, you can make a reasonable apportionment. Similar, you have to make that apportionment for your accounts anyway. So, you know, it'll follow that basis. In terms of the interaction with the rent credit, there's another section 4.3 of that guidance looks at where there are deductions. For example, if you've signed up to a new energy provider and you get the discount for switching and things like this, the guidance sets out how you can approach those quirks. But really, the question came up again around management companies, and again, look, if you're not taxed under case one, you're outside the scope of TBES. It is, as I said, that's where the legislation is presently, and there has to be, I suppose, you know, because this is coming under the temporary crisis framework. There has to be kind of narrow rules around who can apply it and things like this. And but I suppose that, look, they're some of the key themes that are coming out there. Really, in terms of whether you're trade qualified, you'll have to look at the legislation, and I guess to my mind, it is the case one or case two. There doesn't at present there isn't sort of a guidance or a any sort of anything, nothing is issued from revenue. Tongue-tied again. Nothing is issued from revenue here to say that anything other than a case one or case two trade is in scope. And as I said, the case two professions initially were out of scope, and on a strict reading of the legislation as it initially was announced, doctors, ourselves, lawyers would not have been able to claim, but that has changed. So as I say, the legislation is fairly prescriptive on that. And just another quick query came up again on the EPSWT issues with the under the GMS contracts. Again, look, that has been ongoing throughout the years. Since I've been attending TALC, this has been ongoing. But at the moment, Revenue have advised it's not an issue with their system; it's an issue with the contract, and those discussions we've been told will take place. But a lot of those discussions have been held up because of capacity strains due to finance bill, which is, you know, understandable. And just on the reportable benefit process, noting a good suggestion came in there around, you know, lobbying for an exemption for micro companies. So just to say, at the recent TALC meetings, the various bodies, ourselves included, have stressed the disproportionate impact this measure will have on certain groups. So, you know, throughout the consultation process, that will be a recurring theme, because now it's been put on the record that there are concerns around the impact on such businesses, and certainly it's a very sensible suggestion that at least micro companies should get some level of exemption or some reduced reporting requirements. So we you know, I'll certainly take that suggestion on board, and we continue to feed back on that consultation process as it commences and as it moves forward. So yeah, hopefully just give a quick whistle stop tour there of some of the highlights from the answers. Look, I think I've answered all the tax related questions, so do certainly check out the answers there for further detail.
Oh, Garrod, thanks very much for that. Yeah, I know it's very difficult and to actually go through all those and try to answer them all on the spot. It's so wide and varied, and particularly around this time of year with the finance bill and with the budget. But look, thank you very, very much for making your best efforts. And as you said earlier, and as Leontia says as well, don't forget to check out Tax News on a Monday if you're looking for relevant updates in all areas. That's where you will actually get it all down in writing. We can only cover so much here in 15-20 minutes, and the same for the UK, and even actually the Tax News excerpts that will go out in e-news this afternoon as well. It's easy to forget about it, but it does keep you up, and it's updated pretty much on a daily basis, so it's great to see. Listen, Garrod, thank you again. Listen, Conal, have we any further, I suppose, questions or issues? I saw a couple of things coming in about the ISQM resource pack, and people that are maybe now getting around to buy it, they're asking about discounts. They're not sure what the discount is, what's it about, and different things. Well, listen, guys, the ISQM discount, if you're a PQA license user, you are eligible for a half price on the purchase of the 50% discount on the actual ISQM resource pack. There was links earlier on the slides. If you want to actually avail of that, you can go check out that's in the resource pack, and you can contact practice members. My colleague Bernie, then, if you are a PQA license user, will give you the actual discount code. That's how it works, and then you can go off and purchase it online. So hopefully that'll be of use to you.
One comment that was made to me this morning by a member, not in Practice News itself, but he was talking about TBESS, and he was saying it's a burden placed on practices, because it is obviously a tax driven, and you know there's a lot of tax compliance associated with a claim, and he was observing this was a burden on practices. And I was asking whether we'd lob it on that. I mean, I see Garrod has unmuted and is coming back on. Has that is that a common theme, or if you're anybody else make that comment, Garrod?
About the burden on practices making a claim on behalf of clients and things.
Yeah. That
I suppose no, that hasn't come up. To be honest, I guess our initial response to the measure that it's a great benefit to individuals and businesses. I suppose our businesses, whether working on a sole trade or within companies and things, they're the biggest issue. I think it's the information gathering piece, which I suppose is all we're really responsible for as advisors. The revenue portal, by all accounts, will complete the detailed calculation. So I suppose it will just be. I suppose it'll be just important that we're using the correct information, the correct reference, and the correct claim periods. But that, to be honest, it is the first I've heard around perhaps the burden on advisors in terms of submitting claims. But certainly, if in the course of these claims you're finding it's taking a long time to process, do feed it back. But just I suppose, to be honest, it's the first I've got that piece of feedback on it.
And me too. So, but I just like I like to try and respond to everybody if I can, and hopefully the person is on Practice News listening. So if not, I can contact them. But look, I mean, yes, it's a good support for small business, especially, and because there's a financial gain to the business, there is an opportunity to charge for it. I appreciate that it comes at a time when people are stretched to the limit and don't have necessarily the resources, but seem to be something that's absolutely necessary to do in order to get people through this crisis, if it even does that ultimately. But that's as much as we can say, I think. All right, Jeremy, back to yourself if there's anything else. Thanks, Garrod. Thanks very much, Garrod.
No, I don't see much further questions coming on from Elaine and yourself and your talk. As I say, I know there's some other, I know you kind of summarized it there. You covered a lot on the legal aspects, and I think we went into some aspects as well on the finance aspects of deals. As I said, it's an area that you could actually do a whole day on the different aspects, and we look at this for CPD courses and so on as we go ahead into next year. Today is very much 20 minutes on the legal aspects, some food for thought and things to prepare if you might be into selling your practice in the coming years and incorporation as well. And that's pretty much it. Yeah, Conal, if you had the slides there, but again, just to look ahead to, I know that we're coming into a period of the year where people are looking to catch up on their CPD. They've been through the tax season in the Republic of Ireland, and they're looking to catch up on their CPD. And we're always asked about what courses will be coming up in different ends. And we do have two very important courses: financial reporting, firstly, FRS 102, 105 next Tuesday, and we also have auditing on the following Wednesday, the 14th. Both half-day courses, and we have links to them in the slides that you would have received there with relation to. They've been very, very popular at the moment. I see we have some questions coming in on auditing and financial reporting there as well, which we would more cover off in those technical webinars rather than getting into detail on things like that today. But hopefully some of you will be able to join us for one or both, and they all will be recorded as well.
There we go. So now I should have been showing you those links as we were talking through that. They're just at the back anyway, as I say to you, of the slide pack that you'll have, as I say to you, and you have the dates there. And listen, you'll be getting emails from us as well with relation to the actual the upcoming courses. We'd be delighted to have you along. I suppose, yeah, as Leontia said, it's been great to actually, and you said as well, Conal, it's been great to actually do these Practice News webinars, and that they are getting such a good attendance and demand for them as well over the last year. I think this is 6 we've done, and we'll be starting off and kicking off again early in the new year, probably in early February. We haven't exact dates, but we will be communicating those to everybody as well. And as I mentioned, we have a few that we're looking at potentially getting Maeve and the Maeve Hunt, new members of practice committee chair, on as well, and just other topics as well. So we'll keep going with those, and listen, it's all good. Conal, has anything come in there to questions that you might have? Anything at all there now that's been asked? Somebody was asking about the CRO accepting DocuSign. No, the CRO don't accept DocuSign, as I understand it. When last we checked, they would accept ROS signatures, but not DocuSign. So that is where they're at the moment with that. Okay, guys, listen, I think we're done. I think we're done. So thank you very much for everyone for staying on. I can see we still have a good number of people there, so thank you very much. We better wrap up now and let you get back to the rest of your day. Have a good weekend. And if we don't talk to any of you before Christmas, have a very happy Christmas. So I'll say that to you.
Indeed, and let's to thank as well our technical team, CPD
Absolutely.
team, and so Chris, Shannon, everybody else in the CPD team to help us out, and of course our guests Elaine and Garode and Leontia for actually joining us here today or preparing materials. It's been very, very informative. Yeah, we've ran a little bit over time, but listen, so many questions. I think it's better to get the questions covered, and the recording will have it as well. So great to have you, and thanks guys for taking the time to be with us today.
Thanks very much, Jeremy. Look after yourselves. Take care now. Bye-bye.